Okay. Now let's talk about the using purchase orders. In QuickBooks, there's a function, or part of the functions of the under vendors is doing purchase orders, receiving items, and then entering bills against those items. So this really involves inventory. So now you guys, no one deals here in inventory, do they? So I'm just going to go through, I'm not going to go in a lot of depth here. I think John yesterday, he would have got more value out of this. So let me just show you how the purchase function works, and I'll just walk through, if you, because someday maybe.
We use purchase orders.
Okay,
We
good.
don't have inventory.
But you don't have inventory. Okay, so then we'll go through this. Purchase orders are a vehicle you use to communicate what you want. And it's sort of, it's a formal document. It's a legal document, if you will. Depending on what boilerplate information you have on your purchase order would determine your level of commitment. Most purchase orders say we can change our mind at any moment for any reason without consequence. So purchase orders aren't as, I guess, they're a contingent commitment to what you have, your language, based on the language you have on the purchase order. So they're not like set in cement usually. But the way it works is first you want to pick a vendor that you're buying it from. So let's say I was buying something from this Diego Lighting. Okay. So if I want to assign a class to it that it would relate to, I'd assign that. I could also say, if this is for a project or a job, I could indicate, I'm going to close this. I can indicate what job I want this related to. Basically, if I'm working on a job, let's say I'm doing this family room for this Chris Baker, if I don't need the stuff to come to my office or warehouse, whatever, I'll just have it drop right to the site, save the freight, right? Save the freight and time. Just have it go to where it's needed. So once you drop ship it, then it assumes that's the customer job this is going to relate to. And you'll see that automatically populate down here when I put in the items. The template, you can choose whatever template is available, okay? Now again, we'll talk about later today how you can customize templates. In this case, there's only one purchase order template, so that's what we're going to use. Now, once I picked that vendor, then all the vendor information came up. I've got my drop ship to location. If it was something different, I could pick something over here. The PO number is the next in the sequence. Just like all forms, purchase orders have their own sequence. You can always change it, and then that becomes a new sequence, but it does have its own sequence.
Can you bill it to a job without it being drop shipped?
Yeah. Well, yes. Yes, you can. You just blank this out, and down here you would assign it to a job. Okay?
And the customer.
Yeah, down here. But if you do put it up here, watch, it'll automatically populate down here. But the answer is yes, you can separate them. So let's say we're going to buy a kitchen sink deluxe from this Diego Lighting, and see it automatically put in Chris Baker because it assumed if I'm drop shipping to that location, that's the job. Now, if it wasn't, I can change it or blank it out. What this does, it associates that I'm purchasing this item for Chris Baker for the kitchen or whatever, the family room. I don't know why you'd put a kitchen in a family room, but you never know. Maybe they have a wet bar or something. So that's the purchase I'm making. I can put in a message here. I can put in a memo. And once I'm done, I would just save and close it. Okay? Everyone following me so far? Okay. So notice, though, that I have unit of measure as a case. And maybe that's not right. Maybe I don't want to send them a case, one case. So if I look at my choices, I can convert the case to eaches. Because in unit of measure, which is one of the lists, you can set up equivalent units. You could say a case equals 24. And in this case, that's what it does. So maybe he only needs one, right? So I just put one. But the problem is, I can't buy one from Diego. I got to buy a case. So maybe I would have had to bring the stuff to my place and then end up just using one for Chris, okay? I'm just using this as an example. I'll go ahead and just sort of leave it like it was, but I'm just pointing out an example. Sometimes, depending on who you're buying from, you may have to buy more than one of something, and if that's all that relates to the job, well then, you may have to break it out. But we'll just say, okay, he needs a case of them. He's got a crazy family room with 24 sinks he's going to have in it. Okay, so once I'm done with this, I'm just going to say save and close. And so now my purchase order goes out, and then the next thing that hopefully happens is the vendor will send the stuff to the Chris Baker site. So now he sends it to the vendor sends it out. So now it's time to receive the items. And I can either just receive the items in QuickBooks, or I can receive and enter bill, which is normally the case. Usually they send the stuff out and they send you a bill, okay? Sometimes that's how you know they sent it out, is you get the bill. So let's just pick receive items and enter bill. So when I pick this, I go ahead and I put in Diego Lighting and watch what happens. It says, hey, you've got an open PO for this vendor. Do you want to receive against one or more of these orders? Because I could have multiple purchase orders out there. So I say yes, I do want to receive against it. I have 3 orders out there, but the only one I'm interested in is this one, this last one. So I pick that, say okay, now watch what happens. It populates the information from my PO right in here, and it puts it in the item tab because it's an item I purchased. So QuickBooks knows I have a purchase order for an item. It knows to put in the item tab, and it populates all the information. So as long as this all is correct, I'm all set here. So I can go ahead and put in the invoice number from the vendor, okay? And if I need to change the dates for any reason, I can do that. And I'm all set. Now, sometimes on a purchase order, I don't put every potential cost on it because I don't know what's going to be. So what's a cost that you can think of that may not be known when you do the purchase order? Shipping. So shipping, let's say I got charged $200. Now I don't have shipping as an item, so I would just record as an expense, freight and delivery, and put $200. So now I've got, that's say the invoice is $5,000. So it's made up of $4,800 of items, $200 of freight. Notice I'm using both tabs, and that's fine. But do you see why I'm using different tabs? One is an expense that I'm going to expense right now. The other is inventory that I'm going to actually inventory and track quantities in dollars. Okay, so once I have this, it's right, I hit save and close, and it's set up as a payable. And then I'll pay it at some later date. And boom, I'm done with that process. I mean, that's all there really is to it. You're ordering it through a purchase order, and you're receiving it and recording the liability. And then your records are updated now with QuickBooks, the quantity and the dollars, and it uses a weighted average cost of what the inventory value is. And then when you sell things and bring new stuff in, the weighting changes, but QuickBooks tracks all that. So QuickBooks does quite a job of following all that and keeping it straight for you. Okay, any questions on that cycle, purchasing and receipt? Then if you ever have to change inventory, there is an ability, there's an inventory center that you can go to, and you can adjust quantities on hand if you need to, if your balances get off, but it sounds like none of that's pertinent. Do you guys want me to show you that, or do you care? Does anyone care? All right. So I'm just making you aware this exists. It's pretty easy to do. And then if you're ever in manufacturing, you can actually build assemblies, but that's not going to pertain to anyone either. Okay, so we've covered that. Now the next area I want to get into, a very important area that you'll inevitably, if you want to keep accurate accounting records, you're inevitably going to have to use journal entries. Now I got a little matrix here I came up with, and I'm going to explain how this works. Okay. QuickBooks, as I indicated earlier, I better put a stop in here. She won't be able to as I indicated earlier, QuickBooks is date-driven, but in a singular way. So in other words, think of every transaction you've ever done in QuickBooks, whether it's enter bill, write checks, invoice, credit memo, sales receipt. It's always one date. Always one date you associate with that transaction. But what if you run into a transaction that relates to more than one period? Quarterly dues, annual insurance expense, buying an asset that you're going to have that has a useful life of 5-10 years, or like a building, 30 years, 50 years. How do you deal with that? Well, QuickBooks doesn't have a way of breaking that out when you're in the transaction, because it doesn't let you do multiple dates for a transaction. So what you have to do is end up using a journal entry. Okay? Now, journal entries are under the company drop-down, and there it is, make general journal entry. And when you open this up, you get this window. Now, in Premier, you get these, history of entries down here, and then it totals it up for you, debits and credits. And in Pro, I don't think you don't have this down here, and I guess, Eric, you were pointing out, because I usually use Premier, that doesn't even total them for you. Maybe the newer, do you have 2013? And it still doesn't? God, I thought it would.
Well,
by
we
now.
had Premier and we just upgraded.
Oh,
And
well
they
then.
said, the thing they were pushing Premier for was if you inventories. We don't know.
Right. Well,
Tell
and
us.
sales orders, that was the other thing, but it doesn't run, yeah. So anyway, that the journal entry, the thing with the journal entry that really intimidates people is this thing, debits and credits. Because people can usually figure out what accounts they need to deal in. At least they know one of the accounts. Sometimes they don't know what the other account should be, but they know at least one account. But the other thing is the debit and credit issue is problematic for many people because they don't understand that concept, and they don't know all the rules of what should be a debit and what should be a credit. So what I've done for you guys is this is a little cheat sheet or a little journal entry matrix that I put together so that you can use this to figure out whether you should debit or credit something. I mean, it's somewhat foolproof if you use it correctly, and I don't think it's that complicated. So what this sheet shows you is in the first column, let's start with the second column. The second column indicates the account type. And really it sort of sounds simplistic, but it's true, that there's only 5 types of accounts in accounting. There's assets, liabilities, equity, revenue, and expense. Okay? And those are the 5 types of accounts. So every single account that you ever come across in your chart of accounts will fall into one of these 5 broad categories. Now, of course, there's designations like current assets, long-term assets, current liabilities, long-term liabilities, restricted equity or unrestricted. There's little subcategories, but in general, everything falls in one of these 5. You give me the account, tell me what it's for, I'll tell you what type it is. So, the rule in accounting is if something, like look at asset, and assets, liabilities, equity all go in the balance sheet, and revenues and expenses are in the profit and loss statement. And pretty much in your world, those are the 2 financial statements you use. Balance sheet, profit and loss. That's universal around the world, pretty much. Those are the 2 key financial statements that get used. So if you look at this matrix, on the first line, the way accounting works is if an asset is being increased, basically you're buying an asset or you're getting an asset, it's a debit. And if it's being decreased, it's a credit. So in the language of accounting and this journal entry, here, these are the debits and credits you have to complete. If you bought a piece of equipment, let's say you had a piece of equipment, it would be, what would it be if I bought a piece of equipment, a debit or a credit? Debit. Why? Because I'm increasing it, right? An increase means you're adding, right? So let's say I bought a $45,000 piece of equipment. Now, what am I giving up for that equipment? Usually I'm given what? Money, right? Cash from my checking account. And is that an increase or a decrease in my asset? Decrease. So what should that be? Credit. Now the rule in accounting is debits have to equal credits, and I meant to be 45,000, so hold on a second here. So am I in balance? How do you know I'm in balance? Because the two numbers equal, right? Now, think of this. This transaction was a swapping of assets, right? I swapped one asset for the other. I swapped cash for equipment. Now, if I didn't use cash and I had a loan, what type of account is a loan? Liability. When you increase a liability, is that a debit or a credit? Credit. And isn't that what I did? Is I credited, if it would have been a liability, I would have credited it. See how this matrix works? So the liability is the opposite. You increase a liability with a credit and you decrease it with a debit. Make sense? And then equity works the same way. Increase with a credit, decrease with a debit. Revenue works the same way too. Revenues, you increase with a credit, decrease with a debit. Expense is like an asset. Increase with a debit, decrease with a credit. Okay, those are the rules. If you know those rules and you know what account you're dealing with, you can answer the question of whether it should be debited or credited, right? So we're going to do a couple examples as a class. And we're going to see if you guys sort of get this. All right. So I'm going to set up the transaction, and then I want you guys to tell me what to do from beginning to end. And we'll take one step at a time. All right. Here's the situation. I'm going to buy a piece of equipment for $60,000. And I'm going to pay cash for it. I'm going to write a check. I got a lot of money. I'm going to buy a piece of equipment on January 3rd for $60,000. I'm going to buy a piece of equipment. All right. So what's the first part of the transaction? How should I record this first part of the transaction? Now think very simply on this. There's no trick here. It's a very straightforward transaction. What am I?
Asset.
Well, first of all, where am I going to go to record this first of all?
Company, general journal entry.
Well, let's say I don't use a journal entry. Let's say I do it the normal way.
I just write a check.
Yes. So where do I go? Tell me where to go. Banking. Write checks. Okay. So let's say, and it's going to come out of my check account. What was the date I said?
January 3rd.
January 3rd. And it was for how much? 60,000. That's right. And we'll just say this is check 1, 2, 3, 4, 5. And let's say I'm going to buy it from, I don't know. Let's find someone. I'm not going to buy it from Staples. I'm going to buy it from, Keswick Insulation. Now, what did I buy? A piece of, okay, what type of account would that be? Asset. So if I go to my drop-down menu and I go to my asset section, okay, what kind of asset would you pick here? How about this one here? Fixed asset is a long-term asset. I said it's going to be useful like 5 years. Is that a long-term asset? Why is it long-term?
Longer than a year.
Longer than a year. So is that a good choice? I think it's a pretty good choice. This piece of, let's say it was construction equipment. Let's pick that. So I bought a $60,000 piece of equipment. What am I giving up for this equipment? Cash. Will write checks reduce the balance in my checking account by that amount?
Yes.
And what will increase?
Assets.
Right. So if I record this and I went to my balance sheet I would have $60,000 less dollars and $60,000 more of fixed assets, wouldn't I? Under construction equipment. That's how it would look. All right, so let me record this. So this is a very simple transaction to record initially. So I record it. There it is. It's recorded. Now I got on my balance sheet. I'm out the cash. That's gone. And I have a $60,000 piece of equipment. And I start using it. I use it this month, next month, the month after. And I'm just going on my merry way. And I never do anything again in accounting for it. So how long will that $60,000 sit on my books as an asset if I do nothing?
Forever.
Forever. But what's the reality? Am I using up that equipment? Is it losing value every month, basically? Right. So explain depreciation. What's depreciation? You use the word depreciation. What does that mean?
The value is less for every year as it gets older.
Right. It's depreciating in value. It's losing value. Now, I said 5 years. Maybe it'll last 6 years. Maybe it'll last 4 years. Maybe it'll last 5.5 years. It's an estimate, right? So if I depreciate this and I assume I'm using it uniformly over 60 months, how much value am I losing each month then? 5 years is how many months? 60. How much did I pay for it?
60,000.
How much am I losing a month, basically? $1,000 of depreciation expense. So in other words, because it's an expense, what financial statement will it run through? Profit and loss, because it's an expense. I'm referring to this sheet here. Therefore, if I have this expense that I'm recognizing every month, now, do I have to pay for that expense? Do I have to take cash out of my pocket for depreciation? No, because I already paid for the asset, right? I already paid. I don't have to pay again, but I need to but it was all a balance sheet transaction initially, right? I swapped cash for the asset. To recognize the expense, I have to flow it through the profit and loss as an expense. So it's really just an entry I'm making, and it's depreciation expense. So if I go to now, can I record depreciation expense and write checks? No, because I'm not giving up any money. Would I record it and enter bills? No, I'm not going to create a payable. Geez, how am I going to record this? I need to go to a journal entry. So under company, journal entry. Now, we said it's depreciation expense. You already identified that, and everyone understands why it's an expense, right? Does anyone not understand that? Okay, debit or credit for the $1,000. Why? Why debit? Look at your matrix. Tell me why.
It's going down in value.
You're increasing.
I'm increasing an expense. Look at your sheet. What is this account? What kind of account is it? Look on your matrix. When I increase an expense, is it a debit or a credit? Debit. So we know it's a debit. So I know I've got to have an offsetting $1,000 credit. What is losing value? The asset is losing value, right? When I decrease the value of an asset, debit or credit? Look on your matrix. Decrease the value of an asset is a credit. Right. That's what it is. Now in accounting, I could put construction equipment and decrease the value. But in accounting, what accountants like to do is they use an account called accumulated depreciation so that you'll always know the full amount you paid for something, and the accumulated depreciation represents the depreciation that's been incurred, and it offsets that amount. And so it nets it out to a lower number. So if you look in a balance sheet, and this is a standard convention, that people use, is you have your asset amounts and then you have accumulated depreciation, always carries a negative balance to offset the value of the assets that it represents. Now usually I like an accumulated depreciation account for each asset account, but in this lazy version of a balance sheet, they just put it all in one. It ends up being the same, but it doesn't give you that specific breakdown. So that's why you do it that way. So watch, let's go back here. And that will, see, it's an asset account, but it carries a negative balance. Carries a credit balance to offset the debit balance of the asset. You see that?
So if you, it's 125, where you take the full shot. And you-
That's a 179, but that's taxes. That's totally different. Forget
so
about
that doesn't
tax.
show up here.
Well, that's taxes. This isn't taxes. This is accounting. Taxes, tax
It's
laws.
depreciation.
I know, but tax depreciation is different than book depreciation. Tax depreciation is a legislated number that has nothing to do with accounting. In other words, it has nothing to do with proper accounting. It has to do with this is what you can do. A tax return, that's just how it is.
I understand, but that's like,
I know. Well, what they're
there's one reality.
it's public policy. What they're doing in taxes, they're saying, look, we want to incentivize you to buy this, so we're going to give you a break. You can write off the whole thing.
Right.
But in accounting, you wouldn't do that because it's improper matching revenues and expenses. You don't want to show that you've consumed the whole thing on day one because that's not accurate. You've consumed it over time. So you got to separate tax from book. Tax from book, they're different. They use different logics. One is a legislated number. The other is an economically principled system that is interested in accuracy.
As a business owner, well, I don't want to separate them because the legislated, that's the law.
I know, but
You have to.
you're keeping your books for your purposes. You're doing your tax return for another reason.
Yeah.
Okay? Your tax return does not match your books perfectly because of things like depreciation. But you reconcile. The tax account you don't have to worry about that as a
Yeah.
business owner in terms of the accounting. He'll do his tax work for you and keep that separate and keep that proper. But you don't take that same logic and apply it to your books if it doesn't make sense.
It would, I don't want to take everybody's time on this, but it would make more sense if there was one logic. Because you go and sell a piece of equipment and think, oh, we did good. And then you have to pay 50% tax on it because it comes through you as income. If I knew what the real value was, the legislated value.
Well, you can go to your tax return to see that.
Yeah, but
You know.
it's nicer to have one.
Yeah, if you want to do it that way, you can do that on your books that way as long as you understand that.
Yeah,
So again, these books really are for you.
yeah.
So in your case, you're saying, I don't mind it being inaccurate in an accounting sense. I want it to match the tax so I know where I'm at
Yeah.
for that. That's okay. That's okay. But if you presented your statements under generally accepted accounting principles, like when you get audited or you get reviewed, you would either have to put a note in there. What you would normally do is you would present them correctly under generally accepted accounting principle, and then anything to do with tax, you can put in a note and explain that. So there's always ways of communicating those differences. But for our purposes, I'm explaining the GAAP way so that you understand that this is the way you want to do it for accurate accounting presentation. Your point's well taken, but you have to be careful in how you present it because you have to know who your audience is.
Right.
And if you make this assumption that you're saying you can do that, but you somehow then have to communicate that, oh, these numbers aren't under generally accepted accounting principles because I just recognize the full tax amount, so my taxes match, what the books are. That's all. You just have to communicate that. But I'm just showing you the GAAP way, okay?
Because the asset gives you the value of your company.
Well, what it's
Right.
doing is saying, look, when someone asks you, how much did I make this month? Now, some people may think that means how much cash did I generate this month? But that's a different answer question than economically, how much did I really make? Because you have to take into account things like depreciation, this and that. If you just do things on the cash basis, and I buy that piece of equipment on January 1st for $60,000, I record that $60,000 all as an expense, I had a disastrous January because I bought that equipment. I mean, I had such a horrible January, and if someone just looked at my business based on January, it's like, you're out of business. You're done. At this rate, you're cooked. But you say, no, you can't look at it that way. That $60,000 cash outflow is going to benefit me for the next 5 years. So I didn't lose $60,000 that month, or I didn't have an expense of $60,000. It's really only a $1,000 expense. Oh, well, that changes the picture pretty dramatically. That's why that's important, is getting the timing of your revenues and expenses to the period they relate to. Because otherwise, if you do it on a cash basis, the distortions can be wild. They can swing wildly. You know, it's like if I made a sale. Let's say I made a sale this year for $100,000, and I didn't get paid for a year. On the cash basis, you know what my sale would have been this year? 0. But on January 1st, when I got the $100,000, I made $100,000 today. No, I made it a year ago. But if I based it just on when I received the cash, I would say, I made $100,000 in one day. It's not the case. See how distorting that can be? I mean, these are extreme examples I'm giving you, but they nevertheless occur. So you have to match revenues and expenses in the period they occur to accurately reflect what's going on. Okay? So this journal entry will help you do that. So now we record the expense and the accumulated depreciation. So I'm not going to use the construction equipment. I'm going to use accumulated depreciation, right? And now I have things recorded accurately for that month. Now, does everyone see this? Okay. Now, how many more times do I got to do this entry?
59.
59 more times. It's sort of a pain in the hiney, isn't it? What would be a more convenient way of doing the next 59? We talked about it yesterday. Memorize. So I can memorize. See this here? Memorize. I click on memorize. I'm going to call it my depreciation entry, if I can spell it right. And I'm going to make it, I'm going to make, this is a misnomer, automate transaction entry. It doesn't actually record it for you. It just reminds you every month. Not through reminders. It has its own special window. When you open up QuickBooks and it's time to do this entry, it'll be a special memorized transaction window. It'll show you all the memorized transactions you have that you should record. And if they all look good, you say okay, and it records them. But you do have to press a button to record them each period. So I'm going to do it how often? And if this is the first one, then when's the next one going to be?
January 15th.
Yep. And how many remaining? 59. The second I hit OK, it records the memorize, and then I got record the original, and I'm done. I'm done until I get reminded. But it really didn't take a lot of work. I just set up the whole accounting I needed to right here for 5 years, and I'm done. Not too bad. Okay. Does this make sense to everyone? Now, think of there's a lot of examples that you can probably think of in a company where the expenditure relates to more than one period. Now, you don't want to get too carried away with it. For example, let's say you had quarterly dues and they were $120. Now, is it worth doing a $40 a month kind of thing like we did here for $40 a month? No, just expense the $120 in the month you paid for it. So you want to take materiality into account. You don't want to get carried away. You say, well, this mouse is going to last 6 years. I'm not going to depreciate a mouse. I'm just going to expense it, right? Even though theoretically it will last more than that one period. So what most companies do is set a threshold. They'll say anything under $500 or $750 or $1,000. If you're IBM, maybe it's 10 grand. We're going to expense. It's a matter of materiality to your to the size of your organization. Okay? Now, I'm going to give you another example, and I want you to walk me through it, and then we'll take a break. All right, here's the example, and I want you to tell me from start to finish what to do. All right, we're going to, my insurance agent walks in on January 1st, and he says to me, look, last year your liability policy was 16 grand, but I'll tell you what, you write me a check now for 12 grand and you can have the same policy for the whole year. You know, I'm going to say 4 grand, am I paying you now? Say, I'm going to do it. Okay, so I do it. So what do? What's the first transaction I do?
Write a check.
Write a check. Now, if it was a payable, I would have used what instead of write check?
Bill pay.
Enter bill. Enter bill. So let's do write check. And again, it's out of checking account. I said it was 12 grand. What's the date I said? January 1st. Okay. And that's the next check number. Okay. And let's see. Do I have an insurance guy? I think I do. Oh, so-and-so insurance. You guys see an insurance one? Oh, Sergeant Insurance. Okay. So there's the 12 grand. So what am I buying? What type of account should I use to record this 12 grand? I know the cash is a credit for 12 grand that will work in the background, that QuickBooks will do for me. But let me ask, what is the account type that I should use? How should I record this 12 grand? As what kind of
Expense.
account? Okay, you say expense. Do you all say expense? Ah, prepaid. Prepaid what? Prepaid insurance. What type of account is that? An asset. Why is that an asset?
Because it relates to 12 months and not,
One day. That's right. She's exactly right. Doreen's right. Remember, here's the definition of an asset. Something that has a future value. That's an asset. Something that has a future value is an asset. Now, I buy an insurance policy. It's going to cover 12 months. If I cancel the insurance policy the next day, and let's say there's no penalties for canceling, how much would I get back? 12 grand. Because I use 1 day minus 1 day. So if I recognize $12,000 on January 1st as an insurance expense, it would overstate my insurance expense in January. Because what would my insurance expense be in February, March, April, May, June, July, August, whatever? It'd be zero, because I sucked it all up in January. What should it be? $1,000 a month. Because that's how I'm using it, right? It benefits every month. Same logic as depreciation, but I'm unwinding the asset now only over 12 months, okay? So there is an asset account, and it's current because it's going to be consumed within a year, and it's called prepaid insurance. See that? Other current asset, prepaid insurance, because it's an asset that will be consumed. What will my asset value be at January 1st of the following year? Zero, because it's done. I consumed it. So you start out recording it as an asset, but then you're going to, depreciation relates to tangible assets, the term amortization relates to intangible assets. Same logic, it's the recognition of the consumption of that asset. So once I save this, I've recorded the transaction properly. But now, when I do the journal entry, okay, and the first one, let's say, is going to be January 31st. I'll do them each month. Okay, so what am I going to recognize as the consumption of this intangible asset called prepaid insurance each month? For the month of January, what kind of account should this be? Of the 5 types of accounts, what would you think it would be? It would be like depreciation expense, but it would be the insurance expense. I'm going to use the insurance, so I need to recognize it, it's insurance expense. Now it's going to flow through the profit and loss statement. It's insurance expense. So there it is. It's going to be a debit or credit.
A debit.
A debit because I'm
Paying.
increasing the expense, right? It's an increase in expense. That's right. Okay, what is going to be credited? What am I using up?
Yes.
Prepaid insurance. I'm using up the asset. And why is it a credit on the matrix? Because I'm decreasing it. See how this works? Once you know what the accounts are, you should be able to answer the question, am I increasing or decreasing that type of account? Am I increasing or decreasing it? So here's a decrease, and if this is the first one, how many more of these am I going to have to do for the rest of the year? 11. So I'm going to save this, but before I do that, what am I going to do? Memorize it, just like I did the other one. And I'm going to do it over each month, and the next one will be February 28th, because I'm doing these at month end, and there's 11 more, right? So I record that, dingo, and then bingo on this one. And I'm done, okay? Those are your classic kind of journal entry transactions, assets, tangible assets that are going to last more than a month, and intangible assets that are going to last more than a month. That's your typical reason you use journal entries. Those two are probably the most predominant examples that I gave you of why you would use a journal entry. But if anything is material enough, in other words, it's an amount that has meaning to your overall numbers, if anything represents more than one time period, and the time period I'm using is monthly. Okay, so I'm using monthly time buckets as the time periods. If something has a benefit over 1 month or whatever else, then you'll need to use journal entries to be accurate in your accounting. Okay? All right, why don't we take a break for 15 minutes, so we'll come back like 5:02 or so. And, you know, we can, you guys can think about what we've gone over. If you have other questions or other examples, well, how about this or how about that? We can talk about it. But the journal entry is a very important tool that you will use. There's no question you will need to use it at some point, and probably, you know, on a regular basis as you buy things, you know, especially when you're dealing with assets over 1 year or whatever else. Okay? All right, so let's take a break, then we'll come back. We'll do progress invoicing and then reporting.